A single cargo ship just changed the global iron ore game forever. 200,000 tons of African iron ore crossed 11,000 nautical miles to reach China. And, yeah, Australia is watching nervously. This isn't just a shipment. It's the beginning of a new world order in steel. The voyage itself might seem unremarkable at first glance. A bulk carrier, flying the flag of Singapore, loaded to capacity with raw iron ore. 47 days at sea, nearly 12,000 nautical miles of open ocean, one destination, a Chinese port on the Yangtze River Delta. But the cargo this vessel carried tells a far more consequential story. For the first time in modern history, China has successfully completed an entire end-to-end logistics operation that begins deep inside the West African interior, winds through newly built railways, crosses the Atlantic Ocean, and ends at the gates of Chinese steel producers. This isn't a trial run. This is the culmination of more than 10 years of planning, billions of dollars in infrastructure investment, and a deliberate strategy to rewrite the rules of one of the world's most important commodities. And for Australia, the world's dominant iron ore supplier, the implications are impossible to ignore. To understand why this matters, we need to travel back to where it all began, a remote mountain range in the West African nation of Guinea. Stretched across the interior highlands of Guinea lies the Simandou mountain range. For decades, geologists have known what rests beneath its surface. One of the richest and highest-grade iron ore deposits ever discovered. The numbers are staggering. The total proven and inferred resources at Simandou exceed 2 billion tons. The ore grade regularly surpasses 65% iron content, with certain sections reaching nearly 68%. To put that in perspective, that's higher quality than what's typically extracted from Australia's famed Pilbara region or Brazil's Carajás mines. Yet despite its enormous potential, Simandou remained largely untouched for more than 20 years. Why? Geography. The deposit sits on an elevated plateau more than 600 kilometers inland from the Atlantic coast. Between the mountains and the ocean lie dense tropical rainforests, unmarked terrain, and virtually no infrastructure. There are no roads capable of heavy transport, no railways, no ports designed to handle the kind of bulk shipments required for global trade. For international mining firms, the cost and complexity were simply too high. Developing Simandou would require not just digging ore out of the ground, it would require building an entire transportation ecosystem from scratch. That changed in 2022. Starting that year, a series of Chinese state-owned enterprises and private firms moved decisively to acquire stakes in the Simandou project. Today, Chinese companies control more than 51% of the equity across both the northern and southern mining blocks. The southern zone is being developed jointly by Chinese firms, including the Simfer Consortium. The northern block is fully led by a Chinese-backed winning group. Altogether, China has committed over $15 billion just to establish the mining operations and ore processing facilities. But the real ambition went far beyond the mine itself. Chinese planners understood that controlling the resource meant nothing if you couldn't move it. So they made a bold decision: build the infrastructure that no one else was willing to finance. In November of last year, a new railway opened across Guinea. It spans roughly 650 kilometers, cutting through the interior highlands and connecting the Simandou mining area directly to a newly constructed deepwater port on the Atlantic coast. This wasn't a small project. The railway alone cost close to $20 billion, making it one of the largest and most technically challenging infrastructure undertakings in Guinea's history. It was built to heavy haul standards, capable of moving tens of thousands of tons per trip, designed specifically to handle the kind of volume required for large-scale mineral exports. And here's the key detail. This railway isn't just a mining access road. It has been formally integrated into Guinea's national transportation network. It will serve passengers, freight, and commerce across the country for decades to come. The Guinean government now sees it as a critical national asset, one that will drive economic development, create jobs, and support long-term industrialization. For China, the railway represents something else entirely: control over the entire supply chain, from extraction to export. According to official statements from Guinea's mining ministry, both the northern and southern blocks of Simandou are expected to produce a combined 60 million tons of iron ore in 2025. By 2026, that figure is projected to double to 120 million tons annually, and the first customer, China. On January 17th of this year, the Singapore-flagged bulk carrier docked at Magician Port in Zhangjiagang, a city along the Yangtze River in China's Jiangsu province. On board, 200,000 tons of iron ore from Simandou. The ore had been extracted from the mountain range, loaded onto trains, transported across Guinea to the port of Moribaya, and then shipped across the Atlantic. The entire journey took 46 days. Of that initial shipment, approximately 24,000 tons were offloaded and sent upriver via inland waterways to Baoshan Iron and Steel, one of China's largest steel makers, located in Shanghai. The rest was distributed to other facilities along the coast. This was more than a delivery. It was a proof of concept. China had demonstrated that it could now source high-grade iron ore from a region it controls, using infrastructure it built, along routes it manages, and deliver it directly to domestic steel producers, without relying on traditional suppliers. And that's where Australia enters the picture. For more than 2 decades, Australia has been the undisputed king of global iron ore exports. The country holds over 50 billion tons of confirmed iron ore reserves, concentrated primarily in the Pilbara region of Western Australia. Mining there began nearly 60 years ago, and today the region produces some of the most cost-efficient ore in the world. Nearly all of it is extracted through open-pit mining, which keeps costs low. Australia operates a heavy-haul railway network spanning more than 4,000 kilometers, with axle loads reaching 40 tons. The result? Mining costs in the Pilbara average around $20 per ton, among the lowest anywhere on Earth. Australia's iron ore industry is a machine: efficient, scalable, dominant. And for years, it had one primary customer: China. At its peak, China was importing over 1.1 billion tons of iron ore annually. Australia supplied roughly 65% of that total. In 2023 alone, Chinese imports of Australian iron ore were valued at more than $80 billion. But that dependence ran both ways. China needed Australia's ore to fuel its steel mills, and Australia needed China's demand to sustain its mining revenues. The difference? China always felt the imbalance more acutely. Relying so heavily on a single supplier comes with risks that have materialized more than once. In March 2019, a tropical cyclone struck the Pilbara region. Ports were forced to close. Rail lines were damaged. Australia's annual iron ore output dropped by an estimated 14 million tons almost overnight. The result? Iron ore prices spiked. Chinese steel mills scrambled to secure alternative supplies, and Australia's mining giants posted record profits. It was a stark reminder: when one country controls the supply, it also controls the terms. For years, global iron ore pricing has been dominated by a system built around Australian exports. Prices are set in US dollars, benchmarked primarily to indexes like Platts, and determined largely by spot market transactions conducted offshore. The problem with this system? It creates massive disconnects between production costs and selling prices. Australian miners can produce a ton of iron ore for around $20 to $30. Yet during periods of high demand or market speculation, prices have soared past $120 per ton. That's a fourfold markup, driven not by cost, but by market structure. And for Chinese steelmakers, the impact has been brutal. Over the past decade, profit margins at many Chinese steel mills hovered below 1%. Some operated at break-even or even at a loss, squeezed between rising input costs and competitive output prices. Australia didn't need to threaten supply cuts directly. The mere possibility, whether from a cyclone, a labor strike, or rising geopolitical tensions, was enough to rattle markets and send prices higher. China, as the buyer, had almost no leverage, until now. The new rules. Simandou changes the equation. Because this project is financed, built, and controlled by Chinese entities, it operates outside the traditional Western-dominated pricing framework. A significant portion of the iron ore that Simandou supplies to China will be settled in renminbi, not US dollars. Estimates suggest that up to 80% of transactions could eventually use Chinese currency. That's a direct challenge to the dollar's dominance in commodity trade. But it goes further. Around the same time that Simandou's first shipment arrived, China introduced a new pricing benchmark, the Northern Iron Ore Index. This index is based on actual transaction prices between Chinese ports and domestic steel mills, not on offshore speculation or foreign benchmarks. The goal is clear: bring pricing power home. When you control the supply chain, the currency, and the pricing mechanism, you're no longer just a participant in the market. You're shaping the market itself, and that's exactly what China is doing. Beyond Africa. The Brazil connection. China's strategy isn't limited to Guinea. In South America, Vale, the Brazilian mining giant and the world's second-largest iron ore producer, has long been a key partner. Vale produces over 300 million tons of iron ore annually, and China has been its largest customer since 2006. By 2014, more than half of Vale's exports were heading to China. In 2024 alone, Vale shipped nearly 200 million tons of iron ore to Chinese ports. And here's what's notable. Vale has publicly stated that it will not unilaterally raise prices for China. It has also agreed to settle portions of its long-term contracts in renminbi. So now we see the bigger picture: Guinea's Simandou in West Africa, Vale's operations in Brazil, China's massive domestic steel production system. Together they form a supply network that is increasingly independent of Australia. China is no longer just buying iron ore, it's building an alternative system. Australia's dilemma. For Australia, the implications are profound. Losing market share is one thing. Losing pricing power is another. If China can source 40 million tons or more annually from Simandou, plus maintain strong relationships with Vale and other suppliers, its reliance on Australian ore diminishes significantly. And if transactions increasingly shift to renminbi, and if pricing benchmarks move away from Platts and toward China-based indexes, then the entire structure that has benefited Australia for decades begins to erode. Australia still has advantages: low costs, high quality, proximity to Asian markets, but it no longer has unchallenged dominance. And in commodities markets, dominance is everything. Closing thought. What we're witnessing is more than a new mine coming online or a railway being built. It's a fundamental reconfiguration of global commodity flows. China is moving from being the world's largest buyer of iron ore to becoming a rule maker in the iron ore trade. It's investing in mines, building infrastructure, establishing currency frameworks, and creating pricing mechanisms, all designed to reduce dependence and increase control. For Australia, the message is unmistakable. The era of uncontested market power is ending. For the rest of the world, it's a reminder that in the 21st century, infrastructure is influence. Supply chains are strategy. And whoever controls the logistics controls the future. The 200,000 tons of ore that arrived in China wasn't just a shipment, it was a signal.